Hey everyone, welcome to the final bar. Today, my guest is Craig Johnson from Piper Sandler in Minneapolis, talking about bear market rally. What's the long-term picture through the remainder of the year? Also, we're going to answer your questions from the final bar mailbag, questions about where we find resistance here in this bear market rally period. Also, some questions about technical versus fundamental analysis and some other pieces. The market selling off today. It's a heavy earnings week, so it's all about the charts, regardless of what is causing price movements. When there are trends, there is a value to charts. And folks, we have plenty of trends to try and track together. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close to break down the price action of the day from a technical perspective, connect the short-term movements of today, this week, with the long-term trends that we're all faced with. And as I mentioned in the introduction, we're in bear market rally mode, in an unrelenting bear market rally, but today's certainly starting to feel a little weaker. The first day in a couple where you've actually felt some distribution. You had the big gap out of the open, but distribution, another sort of period of distribution going in the last hour, 2 hours of trading. So potentially indicating that we're at that short-term resistance point that so many have been expecting for so long. So we'll try to look at some of the charts together and see what we can do with it. Before we get there, though, I just want to highlight some of the great guests we have coming up on StockCharts TV. As I mentioned, we have Craig Johnson from Piper Sandler on today. Tomorrow, we have Todd Sohn from Strategas in New York. On Thursday, we have Greg Gunther from Agora Financial in Baltimore. Next week, on the 4th, on Tuesday, we have Sam Stovall, a fantastic strategist with a technical component. Always fascinating to talk to him. And then Samantha Leduc is going to join us on the 5th. Also, I just wanted to point out The Pitch is our newest show where we actually feature a conversation with three leading strategists with one of our Stock Charts hosts. Grayson Rose, my counterpart, is going to host that for us and gather some of the best ideas from each of those analysts and have a roundtable discussion trying to dissect the themes and ideas that everyone has thrown around. So don't forget The Pitch coming up on May 13th. Really, really good show. So let's get to our market recap. As I mentioned, we finally have a day of distribution. I feel like after so many, it certainly feels like the consensus view is the market has rallied enough. If this is a bear market rally and not the bottom is in, you'd expect we'd hit resistance at some point. And every time someone has drawn a line in the sand, myself included, we've blown right past it. And we're just getting to that point where I feel like most people are looking for it. Today's the first day. The last couple of days have just been further and further accumulation, sort of raising more questions. What's interesting is you think about the 3 and 3 that I did yesterday with some of the FANG stocks like Facebook, which is reporting as we speak here after the close. You have Alphabet later this week and a number of the others, facing key resistance levels. It could be that point where you start to see the distribution and certainly going into the close feeling relatively heavy. So the S&P down about 0.5%. Down to 2863, was teasing yesterday's close about 30 minutes ago, but plenty of selling going into the close. The Nasdaq was actually in the red for most of the day, which is actually kind of interesting. So, traded a lot lower, ended up being down about 1.4%. So certainly heavier within technology. You can see the tech was one of the 3 lowest S&P groups, down 1.3% today. Mid caps and small caps, though, noticeably were higher. So on a day when the S&P finished down, you had mid and small caps actually higher. So, as much as I'd love to say this was a big distribution day, it's not the sense that I'm getting. It's more of a, reallocation day. You had some of the market doing just fine. You had home builders, for example, rallying really well. D.R. Horton, Lennar come to mind as pretty nice bounces. But then on the downside, you had healthcare, which has been a bellwether relative outperformer. You have technology, which has been a long-term outperformer. Communication services, where obviously we're getting some earnings this week, all in the bottom, the 3 bottom sectors. So it was not necessarily homogenous. It was not a everything up, everything down. You had energy, materials, industrials, all in the positive, up 1.8 to 2.3% for those three sectors, and financials up as well, 1%. So a mixed bag of sorts. Let's look at a chart of the S&P, and then we'll get back to some of the other asset classes, other stories we can dissect here. So with the S&P, as we've talked about for a while now, you have this bear market rally, the 50% line, which is right around here, right around 2,800, which where most people, including me, sort of expected. That's about it. That's about where you'd expect it to get before a bit of a reversal. We've trudged higher. Now we're approaching that 61.8% levels. We're around 29.35 to 29.50 is sort of that level. Above there, you have the 200-day moving average just above 3,000, right? It's going to end up being right around 3,000. So we're right in that sweet spot where, boy, if this is a bear market rally, you shouldn't be able to get above those levels, or I don't think you can call it a bear market rally anymore. You have to call it something different. Today, again, with the finish down in the close, you actually have a candle pattern called the dark cloud cover. It's always a pleasure to dig back into the CMT exam process for exotic candle patterns that may come up sometime. That's where you have a big up bar, a down day the second day, and the close finishes over halfway through the real body of the first day. So that's a short-term sort of bearish candle. What's interesting about that, I mentioned, with Amazon. So if you look at a chart of Amazon, you actually had a bearish engulfing pattern yesterday. We had a big down close engulf the previous day, and we had a follow through to the downside today with Amazon down about 2.6%. So again, what's happened is that big mega cap trade has struggled. The FANG trade, which we've talked about for I don't know how long since the show began here, has been weaker the last couple of days. Small and mid caps actually going higher. So in some ways it's a repositioning of sorts. In other ways, it's people moving out of some of these safe havens that they've been in for quite a while. And that could be what we're seeing, is that maybe people expecting more of a bear market rally and getting out of the defense that they've been in. But I don't know. When I see the FANG stocks starting to roll over, that certainly doesn't feel great from a long-term perspective to me. We'll have to see how things play out, of course. Around other asset classes, so bonds up higher today. And again, there are plenty of times when bonds and stocks move together. This is one where actually they disagreed. They were, both sort of higher out of the open. Bonds continued higher with the TLT finishing up 1.2%, while stocks obviously finished down. The dollar holding in there okay with the UUP around 27. This has pushed the rally in bonds has pushed the 10-year yield a little bit lower today. On the commodity side, gold was actually down a little bit. We're going to look at that chart a little bit later to see what's happened. Oil continues to just rupture, continues to be challenged, although within commodities, certain commodities doing better than others. So it's all sort of relevant. So the precious metals, gold and silver, actually finishing lower. In terms of groups and industries that did well today, you had home construction actually at the top. And if you look at the chart, it's actually a pretty constructive chart. I mentioned D.R. Horton and some of the other home builders were some of the biggest gainers in the scooter rankings today. This is an interesting group. On a relative basis, had been sort of a sideways choppy group. If you look, the relative strength came down as the market sold off. It was sort of leading the way down. But since then, sort of a market performer coming out of the lows. But look at how it's accelerated higher, with the group actually closing much more positive. And if we look at some of the particular names, so this is LEN, Lennar Homes, which with a nice gap above the 50-day moving average, up 9% today. D.R. Horton was another one I mentioned. DHI, again, a gap higher, closing above the open. The RSI still in an uptrend above the 50-day. This is up over 11% today. So this is a group that's actually up pretty meaningfully today, and the chart's actually holding up very nicely. Airlines are another one. So if you think of home construction as something that's really starting to show some accumulation over time, airlines is sort of the opposite, a group that's been so beaten down. So yes, I will totally acknowledge breaking above a trend line using the previous highs. Yes, I will acknowledge one of the bigger gainers today with the group up 8%. I will not concede that it is a decent chart from a relative perspective when you look at all the other charts out there. So there are plenty of stocks that are in much more constructive positions. So I still don't see airlines as a great technical play, especially as a trend follower. But if you're more of a bottom fisher, you certainly have a rally out of the lows there. REITs have been an interesting space. And so you have retail REITs and mortgage REITs actually up pretty meaningfully today after being, obviously pretty painful part of the market here for a little while. On the downside, we have delivery services with a bearish engulfing pattern. This is a group within industrials. You have some healthcare. So this is medical equipment, down 3% today. Within communication services, we have internet stocks. And obviously, as I mentioned, Facebook reporting after the close today. You also have within technology, software, you have biotech. So again, what concerns me, and again, this is one day, so you don't want to draw too many conclusions on one day. But when I start to see groups like biotech leading the way down, groups like software, internet, medical equipment, some of these have been some fantastic outperforming groups. And when you see those charts starting to turn lower, that tells you there's a change in characteristics. We looked yesterday at the chart of Microsoft and some others. Apple, for example, same thing. Both have had nice runs, but both putting in a bit of a lower high. The relative strength of this group, of the software group, actually testing a new 1 month relative low. And while not the end of the world, looking to see a group like this make a lower swing high, making a new relative swing low, the RSI not really getting above 60, it starts to feel like a group where we're rotating away from there. It's more of a bear market characteristic than a bull market characteristic, suggesting perhaps a bit of a short-term top in place for that group and perhaps for the broader market. We're going to take a quick commercial break. Be back with my guest Craig Johnson. Hopefully, he will help us answer some of the questions about what's next for stocks. We'll see you back here in a minute. Hello, everyone. Welcome back to the show, The Final Bar. Thanks for joining us every weekday after the close for the show. Please keep your questions coming to us. We're going to have a mailbag segment in a little bit later today, and you can send questions and feedback to us. TheFinalBar@StockCharts.com is the best way to get things in front of us. I want to welcome on my guest, Craig Johnson from Piper Sandler. I've known Craig for a number of years through our mutual involvement in the CMT Association. We actually sat down with Craig a little while ago for our Behind the Charts show, which is actually a really fantastic interview, a chance to pick Craig's brain and how he incorporates charting, how he incorporates technical analysis into his discussions with institutions. Craig, welcome to the show, my friend.
Thanks, Dave. Thanks for having me back on.
Of course. So as I was mentioning earlier before we just brought you on here, the question I think on most investors' mind is, bear market rally mode. At what point do we find some sort of resistance? Potentially today, we're starting to see a bit more distribution than we've seen in the last couple of days. What does this last couple of days, last couple of weeks, how does that fit into your view, and where are you seeing things head right now?
Sure. So I'm going to push back a little bit on the bear market rally mode, because I really do think that the lows were made on March 23rd, and we've already recaptured about 50% of the advance from those February highs to those March 23rd lows. It's interesting, Dave, inside of our work, what I'm finding is that this is only about the 5th time since the 1960s I have seen some of our measures of market breadth and some of our new high-low indicators and some of those tools. They have actually only gotten to zero now for the 5th time since the 1960s. And when I've seen this occur, it has usually been a pretty good sign that the bottom was made. And from our perspective, I think this is more than just a bear market rally. And again, not to be controversial with you, but as I look at our indicators, they are just now starting to re-expand. And what I'm seeing is it's not just a handful of the Magna stocks or the FANG stocks, or however you'd like to phrase them, that have been moving up. Actually, we've been seeing some profit taking in some of those names, and we've been starting to see names and the breadth of this market starting to broaden out a little bit, which I think will ultimately be a healthy sign. But Dave, if I think forward from here, where we're going to go with this market, I think we're going to probably push ahead a little bit further as we work our way through earnings season, and then we're going to ultimately end up going, I think, sideways to consolidate. I've been kind of looking at this as kind of a square root sign. We've already gone down, we're coming partly back up. There's a period here where we're going to go sideways for a while. The market is going to heal. We're going to consolidate, probably in a range of about 2,800 to 3,000. And again, what I'm seeing with today's price action specifically that helps supports that kind of thesis and view is right now I'm starting to see people trying to buy some of these more value names, stocks that have been beaten up at this point in time. Yes, we've seen big rallies in the home builders. We've seen rallies in the airlines and those particular areas. There's a lot of people that are trying to play catch up in this tape right now. They didn't catch the lows. They didn't believe it. And now they're at a point in time where we're starting to see the small mid-cap names rallying and trying to play a bit of catch up. And I think the powder or the money to do that is coming out of some of these large cap names to put that sort of trade on, Dave.
I love that take. And certainly, I mean, what we're seeing today certainly seems to validate what you're saying, right? Where you're seeing rotation away from some of the MAGA names, as you said it, and getting back into some of these more value oriented, some of the groups that have done the worst all of a sudden, starting to accumulate a little bit. I'm curious. So where do you see things going through year end? I don't want to put words in your mouth, but I've heard an upside objective well above previous highs. Where do you see things going from there?
No words need to be put in my mouth. So we're looking for 3,600 by year end on the S&P, and yes, that is going to be new highs and still is higher from where we were back in the February timeframe. And the reason that we've stuck with this price objective is we have always done a bottoms-up model based upon price. We use point and figure to come up with our objectives of where we think this market can ultimately go, but it's a bottoms-up methodology, Dave. And when I go through that methodology, I find that our price objective, since we set it back in the end of November, early part of December, really hasn't changed more than 2% at this point in time, given the recovery that we're seeing here in the market as of late. So from my perspective, 3,600 is still an achievable price objective. I know that's surprising for a lot of folks that might be listening to the show here today, but again, it is a bottoms-up model that we've looked at. So we do remain optimistic, but again, we're going to go sideways here, probably through the summer months, and then finish stronger toward year end.
I hesitate to disagree with you, Craig, only because I remember trying to do that a year or two ago, and I remember it ended poorly for me and well for you, and I think that's the last we need to talk about it ever again. But I do want to ask, let's assume maybe your bull case does not play out. What would suggest to you that we are going to retest the lows? What would suggest to you that things are not as attractive as they appear now? Would it be maybe more of a breakdown in certain names that are starting to recover, or is it more of a macro call if the S&P would break a certain level or a certain divergence? Like, what would be sort of a one chart you would look for right now to sort of suggest maybe the bullish case isn't going to play out as much as you'd want it to?
So, yes, it's nice to win bets once in a while. So we get lucky once in a while. But here's what I've been watching specifically is when you look at your chart of the S&P 500, and if you were to actually go through and look at all the components in the S&P 500, and then also look at all the components that make up the Russell, the NASDAQ index also. And this has kind of been a live spreadsheet that I've had running. Dave, and what I've been watching is I've been watching all the stocks and measuring their advance off of the lows. Okay, and I've been looking at the high that all those individual stocks have been making coming off of those lows. And then I've been looking at what percent of those stocks have, on a Fibonacci basis, retraced 50% of the advance off of those March 23rd lows, or 38.2% of the advance, or better yet, retraced 100% and now making new lows. And that's what I'm watching in real time to say whether we're going to get some sort of, is this a bear market rally, or is this, do we need to retest the lows, et cetera, et cetera. And Dave, when I do that, it's a very simple, straight up analysis. I have found through yesterday that there's only like one stock that in the S&P 500 that has broken below the March 23rd lows, and it was a REIT. I'm not too surprised. And then I do that for the Russell, and I do that for the NASDAQ. And what I found is even for the Russell 2000, I've got less than 10% of the stocks having broken below those March 23rd lows as of now. So I'm watching that in real time to be my gauge to say, do we need to have a bear market retest or not? And right now, my conclusion is, just based upon the weight of the evidence of the stocks, no, it doesn't seem to be the case. And let me tell you, from a pain trade perspective, that would be the most painful thing for most investors, is not to get a retest or a significant correction back, because so many people are waiting for it at this point in time. And also from a money flow perspective, I'll look at some of that data each week. More money has been coming out of equities and going into money market funds at this point in time while the market is advancing. So clearly people are not positioning to try to even get long per se yet. So the more that this market continues to move higher, I think the more difficult it's going to be for people to ignore it, and they're eventually going to have to get back on board with the trade.
Greg, that's a really, really interesting take. Thank you so much for coming on the show. Thanks for sharing your perspective. Hope you and the family stay safe. All right.
Thank you, Dave. Appreciate it.
That was Craig Johnson from Piper Sandler joining us from the Minneapolis area. You know, certainly a more constructive take. It's funny, just on this show in the last couple of weeks, we've had, you know, some relatively negative, sort of destructive perspectives on where things are headed. And then, you know, Craig comes in with a really well thought out, well explained bullish thesis to stocks. But I think his comments on the square root pattern and that painful direction. I had a question as we rotate here into our mailbag segment. I had a question yesterday about the directions of the market and being bullish versus bearish. And I'll tell you, remember, the market can go in three directions. It can go up, it can go down, it can go sideways. And a lot of times that sideways direction, that third direction, can be the most painful because literally no one's happy. Right? It causes the most pain because there's just not enough movement for anyone. So thanks, Craig, for coming on the show today. We're going to move on to our next segment, the final bar mailbag. We'd love to answer your questions. Try to address some things. We're going to answer a couple of those questions right now. I did want to start out with our poll, though. So on the StockCharts TV page, we often have a poll running. So if you go to our website, go to the right side of the StockCharts TV page, you can answer the question. The question we asked most recently: would you rather own stocks, bonds, or gold for the next 3 months? Only 6% of you said bonds, 36% said gold, and over half, 58%, said stocks. So perhaps over half of you are on board with Craig's perspective that stocks are gonna materialize pretty well. It's interesting that very few of you, if any, 6% said bonds. Bonds have actually been one of the, certainly been one of the better performers over the last year, and at times have completely blown out all the other asset classes. The concern is obviously how high can bonds go, how low can rates go, is the question a lot of investors are asking. So certainly you, as a cohort, as a group, over half of you, pretty constructive that the stocks are going to be the place to be for the next 3 months relative to those other asset classes. Let's get to a couple more questions on here. Next question, let's see, was right here. Moving averages. To enter a bull market, ideally prices should trade above their moving averages. What if they're out of order or pointing down with prices trading above them? Or the opposite, moving averages are out of order or pointing up, but prices are trading below them in an uptrend. Should I just wait for everything to line up correctly? That's a really good question. And so I would say this, there are a number of different ways to use moving averages. So I'm going to selfishly give you the way I've learned to use them and made them part of my toolkit. Other analysts, other strategists certainly probably have their own ways of answering this. But, for me, it's a couple things. And I usually say the ideal situation for something you own or something you want to go higher is it's going high. It's higher highs and higher lows above 2 upward sloping moving averages. And that just tells you that the long-term trends are in place, prices above the moving averages. In the short term, we trade above the longer term, and life is pretty good. And on the opposite side, and I'm just trying to randomly come up with a stock that's probably below, it's interesting, I picked ConocoPhillips. It's just traded above its 50-day today, but I'm looking for stocks that are below 2 downward sloping moving averages. And in general, if I own that first group and don't own the second group, I'm probably going to feel pretty good about things because in general, I'm on the right side of those average trends. Now, you're getting into some of the difficult situations where things get sort of flipped around, and I'm just trying to pick up a couple random things. Alphabet comes to mind right now as something that's sort of whopper job, right? It's right around both moving averages, trying to get above its 200-day, but really not able to do it, now back below its 50-day. And this is where I think moving averages are a little less helpful. You have to remember that moving averages are a trending indicator. So they're designed to track trends. So when something is in a clear uptrend or a clear downtrend, you're going to find moving averages give you a pretty good sense of where things are at, where they've come from. But when we're in that middle, and we're sort of in a non-trending market, the RSI of the stock is right at 50, so literally neutral. It's gone nowhere for the last 2 weeks. If you look on a price basis, it's essentially right where it was a couple weeks ago. This is not where moving averages tend as a trend following advice trying to be as helpful. So then I tend to switch more into where is the price relative to the moving averages. So I'm less looking at the direction and looking more at where the price is relative to that 200-day and whether we're able to surpass that. Because again, I've known just plenty of institutional investors that use that as part of their process. So that's the quick answer on how I would do it. Again, moving averages are something we could dig into so much more deeply, and I'll look forward to doing that on a future show. Question number 2 is probably all we're going to have time for today, unfortunately. Mentioned the amount of technical and fundamental analysis on my previous show that was appropriate depending on your particular time horizon as an investor or a trader. Right. Okay. So for the intermediate term, so I usually call that a couple months to a couple years. How would you incorporate fundamental analysis into that plan? So yeah, really good question. So I don't have time to bring up this slide, but I think of the market in 3 time frames. The shortest is a couple days to a couple weeks. The longest is many years. And that middle time frame is what you're asking about, which is a couple months to a couple years, sort of that sweet spot for trend following. So over the long term, over the very long term, I would say that stocks trade to their fundamental valuations. And I think it was Benjamin Graham that said, in the short term, the markets are a voting machine. In the long term, they're a weighing machine, right? So eventually, stocks will trade where they need to go. Technical analysis is about navigating where we're at right now to where that ideal valuation is, because it's usually not, it doesn't just move immediately to where the new valuation is. It takes time and it fluctuates and it overshoots and undershoots that new level. And that's where I think technical analysis is really helpful. So, if you think over a couple months to a couple of years, you then get a sense of trend in price, but you also get a sense of trend for fundamental analysis. This is where quarterly statements can be valuable. This is where you can look at valuations like PE ratios, price to book, price to cash flow. This is where you can look at earnings growth and earnings trends over time. So instead of just looking at one particular earnings release, you can look at a sequence of them and see how the company is able to grow earnings over time. If you're curious what types of fundamental data is helpful over that time frame, I would encourage you actually to look at the symbol summary page, which is one of the newer features we have. Type in the ticker. So just click up here, symbol summary, switch to the ticker. The fundamental data that you see here, those are the types of things that I would pay attention to. And there's a reason why we handpicked these items to be on the symbol summary for a stock, because they're the ones that we feel best represent that fundamental picture over that time frame. We are building out the way to chart these over time, and that's where I think to specifically answer your question, charting valuations over time, charting earnings trends over time versus price can be very, very helpful. That's all the time we have for the Final Bar mailbag, because my producer is yelling in my ear to move on to the 3 and 3, and we're there. 3 charts in 3 minutes. Here we go. Chart number 1, gold, the GLD. This is the gold ETF. I think it's worth noting the GLD is potentially put in a bit of a lower peak. So while it has been in this long-term uptrend of higher highs and higher lows coming out of the low in mid-March, we now have a bit of a consolidation period, lower highs, potentially a higher low. We're sort of in this consolidation range, which is what we call a pennant pattern. And the price either has to break above that upper bound or below that lower bound. And that's why it's a really important chart to watch right now. I think the next direction is going to be really key on the GLT. Chart number 2, we heard from Craig Johnson today with a pretty constructive argument for stocks here, and that it will surprise investors in going, with stocks overall appreciating through the end of the year. And I think looking at some measures of breadth, it certainly validates what Craig was talking about. The percent of stocks above the 200-day has appreciated up to about 20%. It was above 20%. It's back down to around 19. And we had over about a third of the stocks above their 50 days back down to around 24%. So it's down a little bit, but still very elevated from where it was. So you've seen a number of stocks actually rotate above there. I'd want to see those lines continue to increase to suggest that it's a broader and broader increase in stocks. And finally, the chart number 3 for us today is the stocks advancing and declining every day. We're still sort of digesting the end of the day here, but we had about 70% of stocks closing higher on the day and only 30% lower. So on a down day, over half of stocks trading higher. That really suggests to me it leans more on the positive side of the equity space. Suggests that in general things are holding in there very well. Folks, that is our show. I want to thank my guest, Craig Johnson from Piper Sandler, for joining us and being kind and helpful with his comments as always. Please get your questions to us at the final bar at StockCharts.com. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.